Welcome back to Investing Talk Podcast. Today, we're really digging into the upcoming earnings report for ROST Stores. You've sent us some fantastic sources, and our mission here is to unearth the most important insights, give you the complete picture, and help you understand exactly what to watch for as this report approaches. And hey, as always, if you find value in our discussions, please hit that subscribe button, like this episode, maybe leave a comment. Your support really helps us keep these explorations going. And also, if there's a specific company you'd like us to look into, definitely let us know in the comments below.
That's right. For anyone tracking the retail sector, or maybe just curious about how a major company like ROST Stores navigates the current economic landscape, this is, well, it's a fascinating case study. We'll be breaking down everything from what analysts are expecting to Ross's historical performance and, what broader market signals suggest is on the horizon. There's a particular kind of puzzle with ROST Stores, isn't there? They often exceed expectations.
Yeah, they do seem to beat it pretty often.
Exactly, yet their stock reactions are frequently quite modest. We'll be exploring why that might be and what it means for you.
Okay, let's unpack this. By the end of this conversation, you'll be incredibly well informed on ROST Stores with some surprising facts and very practical takeaways.
Yeah.
Let's kick things off with the absolute essentials. When exactly is ROST Stores reporting their earnings, and what are the market analysts predicting for them?
Okay, so ROST Stores is scheduled to report their second quarter results after market close on August 24, 2025. When we look at the analyst consensus, the expectation for their revenue is sitting right around $5.54 billion.
Okay, $5.54 billion. And earnings.
For earnings per share, or EPS, the consensus is $1.54. Now, what's particularly noteworthy here, and something Zach specifically highlighted in their analysis, is that this $1.54 EPS figure actually represents a slight year-over-year decrease.
A decrease? Interesting.
Yeah, about 3.14%. So while it's still a solid number, it's not indicating growth in earnings per share compared to the same quarter last year.
A slight year-over-year decrease in EPS that immediately catches my attention. How does that consensus forecast compare to what ROST Stores themselves had previously told the market to expect? Did they guide for something similar?
They did, actually, and it's quite aligned. Management had previously provided their own guidance for second quarter EPS to be in the range of $1.40 to $1.55.
Okay, so that forecast fits right in.
Right. So that analyst consensus of $1.54 sits quite comfortably, almost perfectly, you could say, at the higher end of Ross's own projected range. This suggests a pretty tight convergence in expectations. There isn't any significant whisper number, that unofficial higher estimate that sometimes circulates.
Right, the street number.
Exactly. Nor is there a major divergence mentioned from this public consensus. That overall alignment indicates that, for now anyway, the market and the company are largely on the same page regarding the expected performance for the quarter.
That makes sense. So expectations are fairly contained, and Ross isn't setting themselves up for like a massive over-delivery from their own guidance. Now let's look at their past. How has ROST Stores actually performed against analyst expectations in previous quarters? Do they have a consistent track record of surprising the market, or are they more of a predictable performer?
This is where the story of ROST Stores gets really interesting, because history definitely gives us a strong indication here. Ross has a remarkable track record of outperforming expectations.
Oh, really? How remarkable?
In fact, in the last 8 consecutive quarters, they've managed to beat analyst EPS estimates 7 times.
7 out of 8? Wow.
Yeah. To give you a recent example, they beat their first quarter 2025 estimates with an EPS of $1.47 against an estimated $1.43, which was a surprise of almost 3%.
Okay.
They also outperformed in Q4 2024 and in many quarters before that. So yes, there's a very clear pattern. They tend to deliver results that are at least slightly better than what the market anticipates.
Wow, 7 out of 8 quarters. That's a really impressive consistency in beating estimates, especially, in a volatile retail environment. But if they're consistently over-delivering, why isn't the market rewarding these beats with huge stock price swings? What does that tell us about investor expectations for a company like Ross? It's a mature, off-price retailer, Rod.
That's a fantastic question, and it really highlights the nature of a company like Ross. Despite their consistent tendency to beat, Ross store shares generally show quite modest reactions to earnings reports.
Modest how?
Well, price changes in the immediate aftermath, say in the first trading session after the release, are often less volatile than what the options market might even imply beforehand. Moves typically range from maybe a positive 3% to a negative 3%.
That's it, just 3% either way.
Pretty much.
Yeah.
Even if there's an initial gap up or down right at the open, it often moderates in subsequent sessions. What this tells us is that while beats are positive, they are often already priced in, you could say. The market views Ross as a stable, predictable performer rather than a high-growth, high-volatility stock.
So stability over fireworks.
Exactly. Investors aren't typically looking for a massive breakout from Ross. Instead, they're looking for steady, consistent execution. And the market appears to be getting that. It suggests the market isn't missing anything fundamental, but simply values stability over speculative upside.
That's crucial context for understanding investor sentiment around Ross.
Yeah.
Okay. Beyond the beats and the muted share price reactions, let's talk about their underlying financial health. What key trends should we be watching there? Are they maintaining strong margins, managing inventory well? What's the story?
Absolutely. Their core financial metrics show a picture of steady, disciplined performance. For instance, their revenue growth has averaged a consistent 2.6% year over year.
Okay, 2.6%. Not setting the world on fire, but steady.
Right. It's not explosive growth, but it's consistent. What's perhaps even more important for a retailer is their profitability. Their net margin has remained remarkably stable, hovering near 9.8%.
Nearly 10% net margin for a discounter. That's solid.
It really is. For a discount retailer, maintaining that level of profitability speaks volumes about their operational efficiency and cost control. Furthermore, their return on equity, a key measure of how efficiently they're generating profits from shareholders' investments, is robust, about 38.8%.
Wow, nearly 39% ROE. That's strong.
Very strong. It indicates excellent use of capital. And it's noteworthy that management has maintained this strong margin discipline, even with what some might consider cautious guidance. Other things, like store growth, they're still expanding, albeit steadily, and inventory turnover also remain very solid. That's critical in retail, right? To avoid markdowns and maintain profitability.
Right, got to keep that inventory moving. Okay, so it sounds like a picture of quiet efficiency.
Yeah.
Were there any major company-specific news or developments during the most recent quarter? Anything that would have notably impacted Ross Stores' operations or, market perception? Or has it just been business as usual?
Surprisingly, and perhaps this feeds into that predictable performer narrative we were just talking about, there haven't been any major company-specific developments or significant news noted in the sources during this recent quarter.
Nothing, no big announcements.
Nope. No big acquisitions, no major executive shakeups, no new groundbreaking initiatives that would drastically alter their trajectory. The focus truly appears to be on the continued, disciplined execution of their established strategy.
Yeah.
You won't find Ross Stores featured prominently on those big must-buy analyst lists right now, nor are they generating headlines for dramatic pivots. They seem to be just, getting on with business.
So if it wasn't company-specific news driving the narrative, what about the broader sector and macroeconomic trends? How's the overall retail environment looking right now, especially for off-price retailers like Ross Stores? They often perform differently in various economic cycles, don't they?
Yeah, they do. And this is where the context becomes incredibly important for Ross. U.S. retail sentiment is currently, let's say, moderately positive. And a big part of that stems from surprisingly resilient consumer spending.
People are still spending.
It seems so. And what's particularly relevant for Ross is that this resilience is most pronounced in value and off-price channels, precisely where Ross Stores operates.
Okay, so people trade down or look for value.
Exactly. Think about it. When consumers feel even a slight pinch or want to stretch their dollar further, they gravitate towards discounters. That's Ross's sweet spot. However, we are seeing truly mixed macroeconomic signals.
Mixed how?
Well, inflation, thankfully, is cooling somewhat, which is generally good news for consumers, helps their purchasing power. But on the flip side, interest rates remain stubbornly high.
Still high, yeah.
And this is a source of pressure, particularly on discretionary retail spending. Higher borrowing costs can make consumers more cautious about non-essential purchases or maybe bigger ticket items. And while the major supply chain disruptions we saw a few years ago have largely receded.
Thank goodness.
Right. But competitive pricing pressures are still very much a factor. Retailers are battling for every dollar. And that means tight margins, which makes Ross's margin discipline even more impressive, actually.
Good point. So given that mixed macroeconomic backdrop, how have analysts been viewing Ross Stores specifically leading up to this earnings report? Has there been a shift in sentiment, any notable upgrades or downgrades?
The current analyst consensus on Ross Stores is a moderate buy.
Moderate buy, okay. Not strong buy, but positive.
Exactly. It's not a strong buy, but it's certainly not a hold or sell. What's perhaps more telling is what we haven't seen. There haven't been any major upgrades or downgrades directly ahead of these earnings.
Oh, interesting. Kind of quiet on that front.
Yeah, it seems some analysts are, shall we say, migrating their focus to other names. Perhaps they're looking for higher new-term upside elsewhere in the market.
Looking for more growth, maybe?
Could be. Sectors or companies that might offer more explosive growth potential. This suggests a slightly less bullish stance, specifically on ROST Stores' relative positioning. Not necessarily negative, mind you, but a cautious optimism that acknowledges its stability without expecting, a dramatic re-rating.
That makes sense. A consistent performer that's not necessarily capturing the most aggressive analyst attention right now. Let's dive into the technicals of the stock. What does Ross's pre-earnings price action tell us about what the market is expecting? Is it building up momentum, selling off in anticipation, or just staying steady?
Well, the stock has been trading in a fairly tight range leading up to this earnings report.
Tight range, okay.
Yeah, there hasn't been a notable run-up, which would suggest aggressive buying in anticipation of a huge beat. Nor has there been a significant sell-off, which would signal widespread fear of a miss.
So no big bets either way.
Pretty much. This tight range indicates a balanced set of expectations from the market. It's not showing strong directional conviction in either direction, kind of confirming that general neutral sentiment we've discussed.
And what about the options market? What kind of move are they pricing in for the stock immediately after the earnings release?
The options market is currently pricing in an implied move of approximately plus or minus 5% for this earnings event.
Plus or minus 5%. What does that mean in plain English?
It means that options traders, collectively, are betting that the stock's price will move by about 5% up or down within, say, a day or two of the report. While our sources don't detail specific call and put option ratios, the general setup typically sees balanced open interest, which aligns perfectly with that subdued directional conviction we just talked about in the stock's trading range. It's a reasonable move, reflects typical post-earnings volatility for a stable company like this, but it doesn't scream massive surprise ahead.
Okay, so given all of this information, the consistent beats, the stable financials, the mixed macro environment, and the cautious analyst sentiment, what are the potential paths ROST Stores could take after this report? Let's talk about the bullish and bearish scenarios for our listeners to maybe consider.
Absolutely. Let's start with the bullish case. The ideal scenario for ROST to see significant upside would be what we call a beat and raise.
Beat and raise. Both parts matter.
Exactly. This means not only do their EPS and revenue figures come in robustly above the high end of their own guidance, maybe even significantly above the analyst consensus, but critically, management also raises their full-year outlook. This forward guidance is often more important than the past quarter's numbers.
Right, looking ahead.
Yeah. Any positive commentary on improving margins or clear signs of accelerating comparable store sales, remember, that's the key metric we discussed earlier.
The comp sales.
Right. That could really spark an upside movement, potentially even beyond that implied 5% from the options market.
And on the flip side, what would trigger a negative reaction? Maybe a decline larger than the market is currently pricing in.
Okay, the bearish case. That would be a miss, especially if their EPS comes in below that $1.40 floor they guided for. A miss on revenue would also be a concern, obviously. But just as important, if management signals margin compression.
Uh-oh. Why would that happen?
Could be higher freight costs, maybe increased promotional activity, competition heating up, or if they point to weaker overall sales trends, especially within existing stores, or maybe new inventory challenges like having too much unsold stock.
Like inventory pile up, yeah, that's never good in retail.
Definitely not. And any downbeat forward guidance, lowering their full-year outlook would be a significant trigger. This kind of news would very likely trigger a decline greater than the 5% that the options market is currently pricing in. It would challenge the market's perception of ROST as, stable and predictable.
Gotcha. So if you had to pick just one metric that our listeners should really keep an eye on when the report drops, what would it be beyond the headline numbers?
For investors, I think more than just the headline EPS or revenue number, the comparable store sales growth, often called comp store sales, is the absolute key metric to watch.
Comp store sales?
Yeah.
Why is that one so critical for a retailer like Ross?
Well, because while opening new stores can boost overall revenue, comp store sales tell you how healthy their existing business is.
Ah, the core business health.
Precisely. Are people walking into those established stores? Are they buying more items per visit? Is traffic increasing? It's the most direct and purest indicator of underlying demand and operational efficiency for a retailer. A strong comp store sales number signals that their core business is thriving, regardless of how many new locations they've added.
Makes sense. Okay, pulling all this together then, what's your overall leaning for Ross Stores right now, and maybe how confident are you heading into this report?
My overall leaning for raw stores right now is neutral.
Neutral. Okay.
Yeah, the setup, as we've explored, suggests a fairly balanced risk-reward profile. We're not seeing strong bullish momentum that would signal a massive run-up, nor clear signals of significant near-term downside that would suggest a, looming disaster. So my confidence score is a 6 out of 10.
A 6. That feels quite cautious for a company with such a strong history of beating expectations. What are the key factors that keep you from being more bullish, even with their consistent performance?
That's a fair challenge. The reasoning is precisely what we've been discussing. While recent history certainly favors beats, right? 7 out of 8.
Right.
But expectations have tightened up a bit, sitting comfortably within their own guidance range. And analyst sentiment, while it's a moderate buy, appears cautious rather than, say, enthusiastically bullish.
So no one's pounding the table for it.
Exactly. They're not rushing to upgrade Ross, which implies limited near-term upside from a major re-rating. So while Ross is a fundamentally solid company with consistent execution, the market just isn't looking for a major breakout here. It seems more like they want a continuation of that solid execution. A 6 reflects confidence in their ability to perform, but tempered expectations for a dramatic market reaction.
That clarity on your confidence level is incredibly helpful. Okay, so for our listeners, what are some strategic considerations they might want to think about, depending on their comfort with risk, as they approach this Ross Stores earnings report?
Okay, good question. For those who are more risk-averse, maybe avoid holding common shares through earnings entirely.
Just sit it out.
Could be wise. Or perhaps consider hedging with protective puts. This strategy involves buying options that gain value if the stock price falls, essentially putting a floor under your potential losses. Given the moderate implied volatility and the lack of strong bullish analyst signals, this can protect your downside.
Okay, that's for the cautious folks. What about those willing to take on more risk?
Right. If you're more risk tolerant, you might consider an at-the-money straddle.
A straddle, buying a call and a put.
Exactly. Buying both a call option and a put option at the same strike price, typically at or very close to the current stock price. The purpose here isn't to bet on a specific direction, up or down, but rather to benefit from a potential large move either way.
Betting on volatility itself.
Precisely. A move that is greater than what the options market is currently pricing in, that plus or minus 5%. If management guidance surprises significantly, a straddle could be profitable due to that increased volatility.
And finally, what about long-term investors? People holding ROS for the long haul.
Yeah, for long-term shareholders who believe in Ross's fundamental business model, you may very well just hold your shares. The fundamental downside risk looks relatively contained, assuming, of course, there isn't a severe miss or a significant negative shift in management's outlook.
Right, barring a disaster.
Exactly. But do be aware that the lack of recent substantial analyst upgrades implies that your near-term upside might be somewhat limited. It's more of a steady-as-she-goes holding than one poised for a dramatic rally right after this report.
So there you have it, our comprehensive look into Ross Stores' upcoming earnings. It's a fascinating exploration of how a consistently solid retailer navigates a nuanced market, balancing its dependable performance with broader economic pressures and maybe somewhat restrained market expectations.
Indeed. This entire discussion on Ross Stores really raises an important question for you, the listener. How much do a company's past performance trends, like Ross's consistent beats, truly influence your expectations for their future? And how much do you weigh that historical consistency against broader market sentiment and maybe the cautious signals we're seeing from analysts and the options market? It's a delicate balance, isn't it?
It really is. Something to mull over as you continue to expand your understanding of the market. Thank you for joining us for this analysis. Until next time, keep those sources coming and keep that curiosity ignited.